Hi, everyone. Welcome to the next installment of Charts in Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX VettaFi. Today, we're going to analyze market positions using long-term moving averages. This strategy helps manage risk by signaling when to be invested and when to move to cash, allowing investors to participate in major market uptrends while avoiding severe bear market losses. First, we'll start with the Ivy portfolio, a globally diversified strategy inspired by major university endowments like Harvard and Yale. It's a simple, equally weighted mix of 5 broad asset classes: US stocks, international stocks, bonds, real estate, and commodities. The key is the timing rule. If a fund's monthly close is below its moving average, you sell and hold cash. If it's above, you remain invested. Looking at the 10-month simple moving average signals for the close of September 2025, the picture is clear. All 5 funds remain in an invested position. Their prices are well above their 10-month simple moving average, with variances ranging from 2.4% for real estate up to 12.3% for international stocks. And the view is essentially the same for the 12-month simple moving average signals, which offers a slightly less volatile perspective. Again, every fund in the Ivy portfolio is signaling invested as of the end of September. One thing to notice, however, is the shift in variance compared to our previous table. VNQ has moved closer to its moving average, now within 2% of it, so we've highlighted it yellow to show that it is somewhat close to reversing positions. Meanwhile, the other 4 funds have actually moved further away from their respective moving averages. Now let's turn our attention to the broader US market using the S&P 500. September was a strong month. The S&P 500 closed out the month with a 3.5% gain, marking the 5th straight month of gains for the index. The market has recovered significantly from the early 2025 dips in February, March, and April. But let's examine the market through the lens of moving averages. We use the S&P 500 as a benchmark to illustrate the effectiveness of these moving averages strategies over time. They don't aim to pick the very top or bottom, but the strategies are great at risk management. To reiterate, we're looking at the index's close on the last day of each month, not the index's monthly average of closes, and calculating a moving average based on the prior 10 or 12 months. So if the close from September 30th is above the moving average, then we hold. But if it closes below, we move to cash. This chart here shows the S&P 500 since 1995 with a 10-month simple moving average. You can clearly see how following this line helps avoid the major downturns like the dot-com bubble burst and the Great Financial Crisis. As of September, the S&P 500 is 10.3% above this line, maintaining its invested signal for a 5th straight month. This slightly longer moving average is even smoother and just as effective at reducing losses. The S&P 500 is even further above this line at 10.9%, also confirming the invested position. And a final variation is the exponential moving average. The 10-month exponential moving average puts more weight on recent data, which can reduce the number of short-term whipsaws. While it has fewer false signals since 1995, it was slightly slower to signal a sell after the market tops in 2000 and 2007. Currently, the S&P 500 is 9.2% above the 10-month exponential moving average, again signaling invested. Now to summarize, all 3 moving averages for the S&P 500 are strongly in an invest position at the end of September. The effectiveness of this strategy is rooted in basic human psychology. Momentum. People imitate successful behavior, both buying into a rally and selling during a reversal. By using a long-term moving average, we effectively follow that trend momentum while maintaining a disciplined, unemotional approach. Now to close out, I want to point out that these S&P 500 charts are for illustration. If you do follow this strategy, you should make your buy/sell decisions based on the moving average signal for your specific investment fund, not the underlying index, as fund returns may differ due to factors like dividend reinvestment. That's all for our September moving averages update. Thank you for tuning in. For more economic and market insights, you can find my content on the Advisor Perspectives website under the AP Chart section.